I work for the New York State Common Retirement Fund, which is one of the largest state investors, state public pension plans in the United States. Very broad institutional investor, very broad investor across all asset classes, essentially, all geographies. Let me talk a minute, though, about the public plan universe and sort of some very similar characteristics across the plans. Typically are very short-staffed, located in the state capital, typically have a fair amount of money to put out, and are often dependent on consultants, and often are not first movers. I'd have to say that New York State Common is symptomatic of all of those, or carries all those symptoms with us. We are a large plan. We have a fairly active private equity allocation. Up to 10% of the portfolio can be in private market activity. We have a much smaller allocation to emerging markets, although growing over the last 2 years, primarily in Asia. And we have a much, much smaller allocation to African private equity. As an aside, or as I have two personal notes to make. Number one, Wale serves on our investment advisory committee. It's a very important part of the overall fund, and Wale is actually the chairman of the committee, so he's another person knowledgeable about New York State Common and the ways that institutional investors or public plan investors work. On a personal level, I was in the United States Peace Corps about 20 years ago as a math teacher in Kenya, and I'm very interested and sort of fond of emerging markets and Africa in particular. The critical theme with all these institutional investors, though, the public pension funds rather, is that everything has to be return driven. The staff and the consultants have to be comfortable with the managers or the capital markets if they're public market investors. They have to recognize that that a manager or an investment will bring an appropriate risk return profile to the overall portfolio and won't throw our risk portfolio out of balance. So it's very important not to have too much volatility. Public pension funds in the United States typically are not attracted to the volatility that some of these markets can bring, and we tend to be very conservative investors. New York State Common is large enough and has been around long enough so that we do have private equity and public equity commitments to sub-Saharan Africa, and I will distinguish MENA from sub-Saharan Africa. On the private equity side, the managers are primarily South Africa based. They're based in Johannesburg. On the public market side, it's again driven by the Johannesburg Stock Exchange more than anything else. And these are outsourced, active managers who invest in emerging markets. So our overall exposure is relatively limited. It's driven by sort of brand name of private equity and public equity managers who can invest in the space. They have to get over the consultant barrier, if you will, and they have to be, by virtue of their brand name sort of attractiveness, they have to be sort of stable and investment grade enough so that a manager, or rather an investor like New York State Common, can make the commitment. We do have continued interest in the space. We're very interested in what we call rest of world investments, both frontier markets and emerging markets broadly. And I anticipate that over the next 12 to 24 months, we'll continue to look at opportunities there. On the private equity side, it'll primarily be fund investments. It's difficult to see us staffing up to have the capacity to do direct co-investments. And, or rather, but there's a continued interest in the space, not just because Wale is the chairman of the committee. Staff is interested. There is the need for broader adding diversification to the overall portfolio. And, ultimately we have to be in these markets, whether they're not quite mature enough. We sort of have to judge that, look for brand names, and sort of hit the I believe button. And to that extent, New York State Common is a believer, but not probably not in enormous amounts of capital.
So it sounds like New York State has sort of gone over the volatility hump to some degree, but it's still, what it's fair to say, is still cautionary going forward, or?
We continue to be cautionary, and I think volatility is part of that. Headline risk is part of that. The last week hasn't been kind to the news. But I think we are over the hump of expanding our investment horizons to rest of world. And by rest of world, we really do mean sort of frontier markets and beyond.
Doing business in Africa, you can't afford to be without Africa Investor.